Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Monday, March 3rd, and it is 5:25 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Market state still in a mild correction, a little less than 5% off of the high for the S&P 500. That's the standout index, though. If you've been following us, you know the mid and small cap indexes are below the 200-day moving average. Nasdaq 100 has been underperforming as of late. Equal weight S&P holding up better than the market cap weighted. Check the trend gauge over here. We've got three red arrows. Leaders, still our leaders list under construction. We had a big team meeting today going through about 50 different names. But by the end of the day, with everything selling off, there's about 10 to 12 strong names. I'll review those. But no sense building a list that is going to turn over. Half of it's going to turn over in 15 minutes if the wrong headline hits the tape. So market leaders red arrow and all the major indexes below our short-term trend line and our medium-term trend line. That's the 21-day exponential moving average and the 50-day moving average. Long term, and the market never gets into serious trouble. All bear markets occur under this level. The 200-day moving average, we're not there, obviously. Small and mid cap not looking good at all. So we've got the green arrow there with the yellow sub arrow. Keeping an eye on out for any leadership, but a lot of upheaval as from an economic standpoint with tariffs, taxes, wars, government layoffs. So the market hates uncertainty, and there's a lot of uncertainty right now. So um, we have been out of stocks since the 21st of February, still hold some equal weighted index positions and market weighted index positions, but no leveraged positions. Some long term leveraged positions for taxable accounts, but they're mostly hedged. So what happened today? Gap up over the weekend. There was some optimism tied to crypto. Trump confirming that there was going to be a crypto reserve, and a handful of crypto shot up big time, big gaps up that carried over to the indexes. S&P 500 gapped up 0.25%, 0.5% on the Nasdaq 100. Mid, small, and Dow all gapped up, put in a high within the first 5 minutes. That never jump the gun. Always wait for things to settle. Uh, oh 05 equals high is my note in the tail of the tape. That's not good. And we sold off in the morning based, and then Trump came on talking more tariffs in the afternoon. Two waves down in the afternoon, little bounce into the close, but a really ugly reversal from the open to the low of the day, and then a mild bounce at the end. So here are the numbers: 21.21 under construction. The big eight, all eight of them lower, averaged by down an average of 2.9%. The RG8s, our eight growth ETF composite, all eight down an average of 3%. S&P 500 had a 2% plus swing from the high to the low of the day, finishing down 1.76%. Equal weighted, a bit stronger as money continues to flow into value sectors. We'll take a look at the rest of the indexes when we go through the charts. Global 60/40 down 0.62%. International developed stocks up on the day. And our flagship GROTECTION portfolio down approximately 0.62%. Our late weighting versus the overall market has been paying off since we went to owning no names back on 221. So here's the S&P 500 strong. Let's go to a 5-minute chart. Strong squeeze into the close on Friday. Seemed artificial. But then the gap open continued it higher. But then, as I said, within the first 5 minutes, we put in the top. Strong move down, went sideways for about 3 hours, another leg lower, a weak bounce, another big leg lower, a bounce into the close. All in all, it means that we went above and then failed against the 100-day or 20-week moving average in the S&P, and we bounced at the 150-day or 30-week moving average. Outside negative reversal with a little bit of a bounce into the close. We're up slightly after hours on. I think it's just volatility. There's emotion in the market when that's the case. Shorter term moving averages really don't mean anything. Those are to assist for entries on a pullback during an orderly market that's uptrending. They mean little to nothing when emotion is in the market, and you can see how big the range was today, and it's expanding. That's a negative as well. We want the S&P 500 average true range to be under 1%. We're just not getting it, as the last 3 days have been a lot of volatility. Good news is we're still above this 200-day moving average. Um, Leaders told us everything that we needed to know over a week ago when they broke down very hard right off the top of the market. Failed breakout. From failed moves come fast moves. Even though the market made a new high that day, leaders were weak. They were weak the following 2 days. They were weak early last week. A little bit of a bounce midweek, ugly on Thursday. Relief rally or squeeze for month end on Friday into the close, and an ugly day today. There's times to be in the market, and there's times to sit on your hands and observe, sharpen your saw, review your trades, get ready for the next up leg, because every day that we're down means we're one day closer to the next rally. Here's the NASDAQ 100 undercutting the 150-day moving average, closing slightly below it, just a stone's throw away from the uptrending 200-day moving average. Let's go back to the S&P 500 equal weight. This briefly regained the 21-day moving average at the open today, but then gave that up and the 50-day, undercut and reclaimed the 150-day as well. Trading better, and that's a function of these high market cap tech names dragging down the market cap weighted S&P 500. You can see the relative strength line for 2 weeks on the equal weighted has been trending higher. Onto the Dow, also showing relative strength over the last week plus. Outside negative reversal here as well into the declining 21 50-day, still above the 150-day. Now the weakest of the indexes, mid cap, further lows below the 200-day moving average. Briefly reclaimed it at the open today, but no such luck, closing at the lows near just barely off the lows of the day, but new correction lows. And the Russell 2000 um, didn't even get up to the 200-day moving average on the bounce this morning, now all the way down to that 2100 level. Just not doing what the bulls want it to. And there's times, like I said, to be in, and there's times to be observing. VIX popped today 16%, 22.78. Not good there. Obviously, if we get so a one standard deviation from the long-term norm on the VIX is about 29. That's when we would start looking for possibly doing some dip buying, expecting a snapback rally. Whether or not it would be a bottom, we don't know, but that is a level that we're observing, is the 29 level on the VIX. Let's go to the dollar. Very strong today. Uh, sorry, very weak today. It was strong the prior 3 days, but the weakness in the dollar didn't help individual names. So basically, it's a failure into the declining 21-day moving average for the dollar. Let's go to precious metals. We'll look at SLV very quickly. That ran into the declining 21 on a bounce and failed after a miserable week last week. GLD was weak to close last week, but regained the 21-day moving average today. GDX gold names strong early, but faded to red by the end of the day. Bitcoin, big euphoric gap up this morning. All it did was fail into the declining 21-day moving average and close significantly off of its lows. On to bonds, broad bond index BND showing up on the day. It actually was it was up on the day. I don't know why that's a red Why that's a red candle, but it was up slightly on the day. TLT also up slightly on the day. That means yields pulled back briefly. Here you can see the 30-year sitting on the 200-day moving average and the 10-year breaking below the 200-day moving average. That's our inner asset correlation. Let's go to the tail of the tape. Some news. ISM manufacturing was weak. That came out at 10 o'clock. The market did a little bit of a dump, then spike on that before rolling over. And when this news came out about GDP now, Atlanta GDP now was positive a week and a half ago. It dropped to, I think, 1.2%, a negative 1.2% last week, and then updated today to a negative 2.8. This is forecasting a recession for Q1. So definitely something to pay attention to as the economy adjusts to some of the new rules that the administration is putting into place. So the keys for today, we're coming in. What's the S&P going to do against the 100-day closed right on it, and the 150-day? Well, failed above the 100-day, undercut and reclaimed the 150-day, so still within that range. NASDAQ 100 broke both the 100-day and 150-day. Russell continues to track lower against the 200-day leaders. Really nothing standing out, a couple here and there. And like I said, we'll go over about a dozen charts in a bit. Day count from up one to down one, 7 days below the 8 day exponential moving average, 7 days below the 21-day moving average. Our expectations continue to remain negative as long as we're below the declining trend line of the 21-day moving average. As far as S&P ATR did pop to 1.11%. It'll be up higher tomorrow. Sectors, defensive sector strong. XLP, UV, and RE, that's staples, utilities, healthcare, and real estate. And foreign stocks positive to the downside. Tech continues to get hammered, including semiconductors. Oil's reversed as OPEC agreed to up production, and biotech was weak today as well. From a portfolio standpoint, again, all stocks were sold on Friday, 221. We're just holding SPLG, RSP, and GLD in our model account. There's other accounts that transferred in. We're managing those. We have a lot of hedged longs with significant gains, and we're cleaning out other stuff that came in as it breaks moving averages. So no trades today. Volatility adjusted beta stays at 0.41. Estimated balance at risk to the downside minus 1.62%. So bottom line on the day, we opened up, but then more tariff talk prompted an afternoon swoon. Tough afternoon. He's going into tomorrow. Still going to watch the S&P against that 100 and 150 day. NASDAQ 100 really got three levels that are bunching up, and with the volatility, the 100, 150, and 200 day, and the Russell continuing below the 200-day moving average. Let's get to some charts. So I said we had a dozen. Well, let's go through them. Start off with the three that we've been talking about that look well, fundamentally sound, money flowing into them. Earnings gaps up, gave it back, but they're holding the 21-day moving average. Bros, we have our eye on this. If this was in a good market, we'd be in this name. Starbucks continues to show accumulation and relative strength since their earnings report, and of course, they've got that Wall Street darling new CEO. And Lilly making a higher high today. Just money flowing into it. It's that simple. It's a combination of growth and a stock that's not too expensive. DoorDash had a nice earnings reaction, sold off a bit, but tight range over the last 4 days above the 21-day moving average. Howmet reversed today, but still sitting on the 21 after a positive reversal in their earnings report 2 weeks ago. Spotify continues to hang right above the 21-day moving average. GS, that's GeneDx, a biotech with earnings, sales and earnings, down on the day, but consolidating an earnings gap up above the 21-day moving average. CRS is a steel specialty alloys company, Carpenter Technology, hanging very nicely above the 21-day moving average. Made a move for a new high today, but those typically get slapped down in this type of a market. Stride, an education services company, ticker LRN, bounced its 21-day moving average after its earnings gap up about a month ago. Raytheon, a lot of talk about Europe uh, kicking in billions of dollars to support Ukraine now. That's lit a fire under Raytheon, and we've got a lot of missiles that we need to rebuild too here in the U.S. after shipping off a bunch of them over to the Ukraine. So we've got two aerospace defense names in this list of 12 names. Nutanix, positive reaction to earnings, gapped out of a very nice base, one we would have bought if the market was right. Three higher closes in a row after that earnings gap up. And finally, nice flat base, attempted breakout today, but relative strength at a new high as well. Reversed at the top of the base. That's Urban Outfitters after reporting earnings last week. Three higher closes as well. So we'll call that the not the dirty dozen, the clean dozen. A dozen the stocks that are holding up, looking good, but definitely not the market to be taking a plunge, as I've said about 16 times during this video. That's going to wrap it. As always, we like to hear from you. The email is don@revereasset.com. The phone's 855 Real Wealth. That's 855 732 5932. If you're interested in becoming a client, email my partner, Dan Stewart, dan@revereasset.com. A 4 to 5% move off the highs. If your advisor does not have a sell discipline to get you out of the way during downturns. You can see how defensive we got just in this move down. Imagine if it's a bear market and we're down another 15%. That's where we would need to be, excuse me, just to hit the definition of a bear market, which is 20% off the highs. You'd be looking at some serious portfolio devastation. Now's the time to bring your assets over to Revere. We dictate, highlight, break down, discuss 5 nights a week on these nightly market review videos. We've got one podcast and a Sunday review. Uh, Everything you need to know about the market, including is it the time to be in or is it the time to tap the brakes? We answer that question every night here. That's what our flagship portfolio GROTECTION is designed to do. A slightly more aggressive version called TurboTection is also an option. And the bottom line is, we just want to avoid bear markets. That's what kills your portfolio, especially if you're approaching retirement. 2022 was 28% down off of the high. That was the inflation scare. And add that on to the COVID scare, which 35% in 5 weeks. We got out of that as well. And it's just a matter of following your rules, our rules, because every big loss starts as a small loss. You can get out of the way early, wait for the wind to be at your back instead of in your face. Seems like a common sense approach to us. After all, that's how you handle every other decision in your life. Wall Street telling you that you can't time the market is just them uh, revealing their conflict of interest, that if you're not in the market, then you're not buying their products. They would rather have you in their products and losing money than not in their products and you protecting your money. And that'll wrap it for Monday, March 3rd. Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.